Chaos is set to hit in just under 30 hours, and the fallout will be nothing short of horrific. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, in just under 30 hours, prepare for a shockwave of economic fallout and an impending blackout that will upend everything you thought you knew. Don't say we didn't warn you. Plus, while the market is dropping, our subscribers are cashing in big. Our newest trades are already turning this downturn into massive profits. Stay tuned to the end of the show to learn how you too can cash in big, just like our subscribers. Now, let's pick today's story up with the headline. As talk of a February 28th economic blackout is spreading on social media, what is this and why is the outcome going to be so horrific? But here's the real issue. What's coming after that is the real blackout, and it's going to be far worse than any of these retailers think. The call to action, or rather inaction that is asking that American consumers refrain from making any purchases at major retailers on Friday, February 28th. The protest comes as people continue to endure rising prices on everything from food and gas to housing and utilities, and this was made big by the soaring cost of eggs, which in January averaged $4.95 a dozen. And what are we hearing from the services sector and the manufacturing sector is it's going to get worse. They're saying that their input prices are rising. They have no choice. There's no other option. They must pass this on to consumers. So over the next several months, we can expect prices to rise. And the problem is, for most American households, they cannot absorb these higher prices, and now what we're seeing on Friday is America standing up to protest. And some postings for the event created by online supporters have suggested a targeted boycott of retailers like Ford, McDonald's, Metre, Target, and Walmart that have ended their DEI programs to comply with an executive order signed by President Trump last month. Our official messaging from the People's Union suggests a boycott of all major retailers with a goal of enacting broader economic change. The change they're looking for is they're trying to tell these major companies that the American public can no longer tolerate rising prices, that we're at a breaking point, and we can see this very evidently in the economy as households are now spending less because they cannot keep pace with inflation. They're cutting their discretionary spending, and even worse, we're seeing the impact on the labor market, and all these are factors are why this one-day blackout is going to get much worse in the months to come. For our entire lives, they've told us we have no choice, that we have to accept these insane prices. February 28th, the 24-hour economic blackout. No Amazon, no Walmart, no fast food, no gas, not a single unnecessary dollar spent for one day. We're finally going to turn the tables. Now, I want to know, are you supporting this movement? Are you going to join in the blackout? If you are, I want you to hit the thumbs up at the bottom right of the video. I want you to weigh in the comments. Tell me why or why you're not participating. Well, I have no big purchases planned for myself, so just by default, by not spending, I'm going to be participating. But I'd love to know where you're at. Again, vote with a thumbs up. Join in the comments, because let's talk about why consumers are now fed up with what's going on, and the situation is only going to get worse. Because when we look at this from the perspective of employers, they're saying, well, we continue to give out raises and we have to raise our prices to continue to give our employees higher earnings. Well, we go right back to the 1991 recession, and what did we see leading into it? Right around 1990, you'll notice that inflation, shown as a consumer price index in blue, against average hourly earnings of production and non-supervisory employees, that one in red, both on a year-over-year rate of change. What did we see? Prices shot up and wage growth slowed. And that's exact recipe you see tend to going into every recession. Now let's move forward to the dot-com bubble. What do we see? Prices went up, but what happened? It didn't translate into higher wages, and all of a sudden, because prices were rising and wage growth was static, we entered right into the dot-com bubble. But let's fast forward now to the global financial crisis, where energy prices sent the CPI surging, but again, that wasn't passed on to workers in terms of higher wages. They couldn't afford it. Next thing we know, right into a global financial crisis. And you can see we almost saw that happen right around 2011 into 2012. I'm going to show you on the next slide why it didn't happen, but you can see prices went up as average hourly earnings decelerated, and this is one of the markers that many people thought we were going to head into a double dip recession. But there was something that changed. I'll show you that in a moment, but let's look at where we're at now, because what are we hearing again from businesses is they're going to raise prices. We heard from Home Depot, they believe that consumers are accepting of higher interest rates, which means they're also accepting of higher prices. What's coming on Friday is consumers saying, no, we're done. We're not tolerating this anymore because we're at a point of no return. And the issue here is, again, wage growth remains historically high, and business is saying, look, if you want to maintain this, we've got to raise prices. But there's another major factor here, and they're cutting hours. That's the issue, because take-home pay is shrinking and prices are rising. And this is something these major employers just don't get. That yes, you're giving out your employees higher average hourly earnings. That's wonderful, but at the same time, you're cutting their wages and you're raising their prices. What you're finding out is your workers can't even afford your own products. No wonder the country is facing a major protest on Friday. Let's take a look at average weekly hours of production of non-supervisory employees against inflation, because we can see, going back to the dot-com bubble, you see this very clear decline in hours worked, and that put us right into that recession, because again, prices went up and paychecks went down. But let's fast forward to the global financial crisis, because while we can look back and see that average hourly earnings were running at a very strong clip and inflation was surging, the problem is hours worked were on a decline. Once again, workers could not afford higher prices, right into a recession. Now let's look at what happened around 2011 to 2012. While wage growth was decelerating against higher prices, you can see average hourly earnings were rising. That, my friends, is what kept us out of the recession. And look what's happening now. We saw a huge drop in average weekly hours. That happened last month, and we know that inflation likely to head higher. And what did we just hear from the conference board yesterday? That they're saying that consumers are having financial pressures. Confidence is plunging because their wages are shrinking, prices are rising, and their outlook for the labor market is getting worse. They no longer believe they can change jobs and make more money, because they're afraid that if they do change jobs, that job may not last. And if they lose their current job, well, their opportunity to enter the workforce once again is actually very low. But something that should be making you a ton of money, that is your trades. Let's talk about how the market's been down the last couple of days, and what have we seen from our subscribers? Cashing in big. Just look at some of these returns: plus 10, plus 6, plus 7. These are fantastic returns that our subscribers have locked in, because not only do we give you great trading subs, we tell you how to control your risk. Stay tuned to the end of the show. Check out those links in the description below, and be sure to use the coupon code for a free 30-day free trial. Stay tuned to the end of the show, because I'm going to show you how we trade and teach our subscribers to keep money in their pocket even when markets go down, because we've got some great trades right now that are heading higher. Don't want you to miss out on those. And a lot of people dismiss the idea, arguing that a one-day spending freeze won't move the needle for major corporations or the broader financial system. And while that may be true, it's the coming blackout. It's what happens after this. The reality is consumers are trying to tell these businesses, look, we want to keep consuming, but we can't afford it at the prices you've got. You need to lower them. You need to give us some relief here. And instead, what are these businesses going to do? They're going to raise prices even more. And the problem is, consumers cannot afford them today. They're not going to be able to afford the higher prices over the next couple months. And then you're going to see, my friends, the real blackout that's going to hit the U.S. economy. But he added the economic blackout could become bigger, and it is snowballing into even more events across the U.S. as the People's Union is planning more blackouts aimed at specific retailers. But wait till I show you what's going to hit the economy and why we're seeing households all across America struggling financially, why their confidence is plunging. It's not just due to the fact that the labor market is weakening. It has everything to do with their household budget. And using internal deposit data from B of A accounts, the study found that the median utility bill payment rose 6% in January from a year earlier. That's more than double the 2.5% inflation rate for energy services in the consumer price index. So we talk about how consumer household budgets are being strained. We're already seeing higher rents. They're now seeing higher energy prices, and they're seeing higher food prices. And these things they have to spend money on. And what does that leave? Less money on the discretionary side of the economy, and that's going to backfeed into the economy. And that's why we're seeing this one-day blackout. And my friends, it's going to get worse, because if retailers think, one day won't matter, wait till consumers stop spending because they can't afford to at all. And that is coming very soon. And over the past few years, a strong labor market and growth in after-tax wages and salaries has allowed consumers to ride out some cost pressures, including rising utility bills. Consumers may increasingly feel the need to ease back on discretionary spending to keep the lights, and the heat on, but it's not about easing back. They're being forced back because their take-home pay is not keeping up with inflation. And we know consumers would love to spend on the discretionary side of the economy. It's a lot of fun. The problem is they don't have the money. And the problem, the bigger one, is they've been putting this money on plastic, and that debt is coming due. As America's credit card debt reaches new record highs, according to the New York Federal Reserve, household debt, including credit cards, mortgages, auto loans, and student loans, is at a new all-time high of $18.04 trillion. Overall debt grew by $93 billion in the last 3 months of 2024, and about half that increase was in new credit card debt. And what's crazy is we know interest rates on credit cards are near record highs, and yet consumers went out and charged big ahead of the tariffs. So what does this mean in the months to come? Not just a one-day blackout, but there's going to be a point, and it's just going to be a very clear one, where consumers say, look, I can't afford these higher prices. I already know I can't, but I got to pay down my debt because I'm worried about losing my job. I know my employer's cutting hours. I know things are going to get worse. But there's another problem here, because high interest rates are another factor behind elevated credit card debt levels. That added income levels have been going up as debt is increasing, which is a positive sign for the health of the economy. So what these political elites and experts are saying is, hey, it's no big deal. You can afford higher interest rates because your wages are going up. Again, they can't see that hours worked are getting cut. They can't see that take-home pay is shrinking and other costs are going up. Households are being squeezed in every possible way. And when we take a look at the current data, we can see consumer loans in terms of credit card data in blue against total incomes, which is average weekly hours multiplied by average hourly earnings of production non-supervisory employees. That in red on a year-over-year rate change. And so what you can see is debt is shooting higher, but pay growth is actually going down and decelerating. Not a good sign, and here's why. Because when we take that total income data, we keep that in red, and we overlay the delinquency rate on credit cards, what we're seeing is major blackouts coming all across the economy. We go back to 1994, and what happens? Total income growth decelerates, and then delinquencies shoot higher. Happens again going right into the dot-com bubble around 2000. We see a deceleration in total incomes, and that comes along with a rise in delinquencies. It was very evident going into the global financial crisis as income started to slow down around 2007, and delinquencies went near vertical around 2008 into 2009. And look where we're at now. We got a little bit of reprieve on the delinquency rate as incomes have stabilized, but we know they're likely to head down, and in a big way. So you can see this one-day blackout is going to turn into a lot more blackouts as households are forced to cut their spending in major ways. And here you can see the impact this is going to have on major retailers all across the country who are still raising their prices and are going to be forced to make some major changes. As we look at inflation-adjusted retail sales in blue against total incomes in red, and we go right back to the dot-com bubble, and what do we see leading into it? Incomes going down, retail sales going down. You can see it happens again in 2006, decelerating incomes lead to less spending right into the financial crisis. It almost happened in 2011 and going into 2012, but retail sales held up just long enough for the economy to turn around, and look where we're at now. Real retail sales largely negative for 3 years running, income stabilizing, but my bet is they're about to head down in a big way, and this is a problem because, again, we look back to yesterday. What did the CEO of Home Depot say? Well, the consumers are accepting of higher interest rates. They can handle higher prices because we're probably going to have to raise them. And then they said their outlook, they said, was actually pretty good. And then today we hear from Lowe's, who says they expect to see a reverse sales slump on improving demand. The question is, where is this demand going to come from if take-home pay continues to shrink against rising prices? Well, it's not going to happen. And they note macro uncertainties ranging from tariff concerns to price-sensitive consumers are weighing on outlooks for the year, while consumer confidence is falling across the age groups and incomes. It isn't price-sensitive consumers. They don't want to be price-sensitive. That's the point. They have no other option. They don't have enough money to cover everything and still do the things they want to do. That's the issue the economy is facing. And U.S. new home sales dropped a 3-month low on rates and storms. And what does this have to do with Home Depot and Lowe's? Well, everything, because their business is all about the housing market. And what we just saw today is that's in a decline. So this outlook from Lowe's and Home Depot that says, hey, going forward, it's going to be okay, as you're about to see, not at all. Supply in the new homes market continues to climb, with sales activity generally tepid as builders are likely to temper construction in the coming months. I can tell you what that's going to mean for the economy here in a moment. The number of new homes available for sale increased to 495,000 last month, the highest since December of 2007. People say housing prices can't come down. Well, builders are going to be the first to aggressively cut when we head into recession, and I'll show you all the reasons why. Because when you talk about Home Depot and Lowe's in the retail space, you can see when we look at the broad retail sales data, just how sensitive the economy is to housing. We go back to 1998. We saw a slowdown in new housing starts, and what happened shortly thereafter, it hit retail sales. Look at what happened right around 2005 into 2006. You see retail sales peak just at the same time that housing unit starts peak. As starts come down, well, retail sales came down with it, and we see that happening now. If builders start to cut back on building, what that's going to lead is to a less demand in retail sales. So you can see, my friends, it's not just about a one-day blackout. You can see a whole series of them are building here in a big way, because if builders come back, it's also bad news for the labor market. We can see that slowdown here right back in the late 1990s didn't have an immediate impact on the labor market, but with a delay it did. And we can see the same thing around 2006. Housing starts started to come down. It didn't have an immediate impact on labor until it did. And how about right now? Well, if housing starts go down, we're already at a point where if things get much worse for labor, you're going to see mass layoffs across the board and in a big way. So in less than 30 hours, the first blackout of what I think are many are coming, as the U.S. consumers are now facing an inflection point. They're standing up and trying to tell big business, look, we've had enough. The problem is, I think it's too late. The economy is headed in a path that's actually going to send us into a series of blackouts as we head right into a recession. But just because the economy is slowing down doesn't mean your trading account has to go down. Again, check out all these returns we locked in. Not only do we show our subscribers some amazing trades, we teach them how to keep money in their pocket, how to lock in those gains when things are reversing. And going into today's trading day, we had an 80% win rate on our CTA Timer Pro, a 100% win rate on our Momentum Timer Pro, and that's fantastic. In fact, we just put on a trade recently. We told both of our subscribers to buy right here. The question is, what is it? Well, this is one of our next big trades. You got to subscribe to find out. Now, what do we do every day? We look at machine positioning, and what we're trying to find is when the machines are off sides and they have to be big buyers. We want to position our subscribers to buy before the machines do and sell before they do. Now, we have a huge advantage. We run historical overlay, so we can see when the machines are mispositioned based on where they should be, and that's our edge. We give our subscribers notes every day. You can see right below here in the box, we tell them what trades to look at, what trades to do. Now, maybe you're trading momentum and you have struggle. You get in late, you get out early, you find out you're buying into a downtrend. Well, we have a proprietary overlay, my friends, that changes the game. We make it so easy to trade momentum. Here's the best part. We give you a 30-day free trial. All you have to do is hit the links in the description below, because you get the reports, and here's the best part. You don't even have to read them, because in addition to all the signals, I give you my opinions on the best trades. We backtest our reports so we know they work. We give you risk control levels to make sure you keep your gains in your pockets. You get a full weekly update. I disclose my personal trading account to you. And again, a 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.